welcome back to our August Economic Update. I'm John Cleaver, partner and senior financial advisor at Beyond Wealth Advisors, and Dennis Bacon, chief investment officer, back again. Before we get going, just one quick little announcement. We're going to be participating in our first ever Beyond Wealth Advisors wing competition called Wings for Water, and it's a fundraiser for a great organization. It's going to be right across the street from our office here in Lee Summit. We'd love for you to come out. I think the pigs can't fly. No, when pigs fly with millionaire bacon. A little sweet, little heat. You're not going to want to miss out. Come and participate with us. We'd love to see you. That's going to be September the 9th. You can reach out to the office and get more information. We look forward to seeing you then. All right, let's jump right in. S&P 500, it's been rocking and rolling, kind of hit some all-time highs. Where do we go from here?
It's going to continue.
Okay. And that's a wrap.
That's a wrap. That's it. Right now, we're seeing a lot of indicators that say the economy is kind of clicking on all cylinders. In the month of July, 9 of the 11 sectors of the economy, or the S&P 500, were positive. So we're really seeing everything look pretty good going forward. We really don't see anything to stop the growth at this point that's apparent to us.
All right.
Yep.
So no speed bumps, as you say, no potential roadblocks.
I said no apparent roadblocks.
Apparent roadblocks on the horizon. So what might signal a change? What might we be watching for or looking for as we navigate here into the school year and end of the year?
Well, I've been listening to a lot of different economists that are far more educated than I am, and at least they have a lot more credentials than I do. But a lot of them, everybody pretty much feels like we're going to have inflation for the near term at least. Some feel like it's transitory. Some feel like it's a longer term thing. And if we kind of look at that longer term inflation, which actually tends to make a lot of sense to me, I think to have a fairly substantial run of here 3 or 4 years where we have 4 to 5 to 6% inflation, I think is very possible. And really it's unprecedented. It's pretty typical of what we saw back in the 70s, 80s, and even in the 90s. So that really isn't as fearful as people who haven't experienced that know. But I think the real risk is during that period of time is some of those economists, and I tend to see that this as a potential risk, is that we have a stagnant economy while we're having inflation. So that would be what we experienced in the late 70s, where we had what we called stagflation. We'd never experienced it before that. I don't think it's really probable, but it is something we need to be aware of and looking for a slowing economy during an inflationary period.
Right.
That's one of the interesting things I think going forward.
Absolutely. So with that in mind then, how does that impact what you're thinking about from an investing standpoint, investments in general, and kind of how we move forward in that type of environment, if we even get to that? Okay.
Well, as we go forward from where we are today, I think it's very important that we understand that both the value and growth side of the economy are going to be doing well. We've had some periods early in the year where value way outperformed growth, which was opposite of what we have had for the last 3 or 4 years. Right now, recently, growth has kind of picked back up. We expect that to kind of go back and forth. With that regard, I know in our strategies that we're using, we have taken a real hard look at all of the investment managers we're using. We're actually kind of getting rid of a few right now because we feel like they're not being nimble enough. And some of them have had manager changes within their organizations, so we really don't have the confidence that they're going to be good investments going forward. But I think the important thing is you kind of stay a little bit more balanced between value and growth. Those are just investment styles, or both of them have the objective of long-term growth. So I think it's important we stay balanced there. The other area that I think is important is that we be aware of changes that can take place and be a little bit nimble.
Right.
particularly in the bond environment. If you have a little more conservative portfolios, that's a very challenging area. We're making some changes in our strategies with that regard, incorporating a few things like preferred holdings, convertible bonds, some of those types of investments that we typically haven't had. We're seeing a good movement in the commodities area. Mainly from an industrial standpoint, but we're seeing some things, some other things. So we're going to start incorporating those, or at least looking to those that we're going to start incorporating into our strategies at this point in time.
Yeah, that's fantastic. Obviously, it's an interesting time. Lots of different scenarios than maybe we've addressed in the past. So with that, how would you summarize the go forward from here?
Okay. In general, we're fairly positive going forward. But I do believe that we need to do two things. We need to stay aware and stay nimble.
Okay.
So that would be the way I would be looking at things. Be aware, not reactionary, but aware. And be nimble for things when you see situations arising that look like they're a trend going forward.
Fantastic. All right. Well, that is a wrap.
That is a wrap.
On the
We're done.
August economic update. Thank you for listening, and be sure to reach out to your financial advisor and have a conversation with them about your situation and kind of how things are fitting in currently for you. And hopefully you can make it out in September to our wing event. We'd love to have you there. And if not, we'll do this again next month.
That's right.
All
we
right.
will.
Thank you.